So as Ryan said, I'm here from Baker Newman Noyes, where I'm a tax partner. So let's just jump right into it. So first, just very briefly about Baker Newman Noyes. So we're a top 100 U.S. accounting firm, really in the public accounting space. So when you say top 100, that means you're not in the top 75. You're between, we're like, oh, there we go. Sorry, Ryan. So we're like number 86 or something like that, but we're the largest tax practice that's based out of the Northeast. But then we have a number of other services as well. We're not just tax, it only comprises about half our business. So there's obviously the tax compliance and consulting, and that encompasses from multinationals to local mom and pop businesses. Our assurance practice, audit, financial statements, cybersecurity assessments, transaction advisory for business sales or acquisitions, and then business and healthcare advisory, which is looking at business processes, software selection, those kinds of issues. All right, so just who we work with, I mean, pretty much it's who don't we work with. We're a relatively large firm for the Northeast. We have around 300 people. So we have individuals that focus in a wide variety of industries, both on the tax side, on the financial statement side. I think for most of you here tonight, really, obviously interest is real estate. You probably don't have, audited financial statements. Probably your biggest interest is within the tax side of things. But I think what matters with having a large firm at your disposal is just the resources available. I spend 95% of my time working with real estate investors and construction companies. We have folks that deal with employee benefit plans, state and local tax, estate and gift planning. Kind of runs the gamut as far as we have those individuals who spend 90% of their day job working in those particular areas to be pulled into and engaged in this meeting. All right, and about me, and then I promise we'll actually move on to something you want to hear about. So we have, I've been in this field for 13 years now. I have CPA license in New Hampshire. I always get that question, is like, are you just limited to New Hampshire? No, I am not. CPA license, have reciprocity essentially nationwide. So I work with investors and construction companies that span, it's about 20, 25 states. It depends on the year, depends on what people are doing. I have my MST from Northeastern and my Bachelor of Science in Accounting from Plymouth State. Not if that means anything to you, but and then as I noted, 90-95% of my client business is in the industry of real estate. And as far as what my clients are doing in real estate, a little bit of everything. There's just from the basic multifamily investing, PERS, development, hard money lending, qualified opportunity funds, 1031, 721 exchanges. You name it in real estate, we're probably doing something. I mean, probably someone's come up with some other way to go about it that I haven't dealt with yet, but we can certainly figure it out. All right, so moving into the stuff that you actually are interested in hearing about. So the agenda of what we're going to walk through, and with this agenda, what I was trying to do is touch on a variety of topics that many of you will deal with as you invest in real estate. Whether it's passive activity, loss rules, real estate professional status. We're all here in the great state of New Hampshire, which has its own significant headaches. Some issues if you're using other people's money to invest in your projects and you're giving them equity. And then just last, assuming we have enough time to get to it, just some questions that really your CPA should be asking you each year as it relates to your real estate portfolio. Hopefully they're not just putting numbers in boxes and they're helping you to be a bit more strategic about things. All right, so passive activity loss rules. So this is really important because when you look at real estate and you talk about the tax issues, a big part of what everybody says, you get real estate, you can kind of create some paper losses. We've probably all heard of cost segregation studies where you're accelerating a bunch of depreciation to get that first year giant paper loss. But the big thing here is, well, what can I actually do with those losses? Can I use them against my other sources of income? Maybe you have a W-2 job and you're looking to offset that income, could create some tax savings for yourself. perhaps you have a bit of an investment brokerage portfolio that you're looking to offset that income. It's like, okay, well, once I look at real estate, you know, all these great tax advantages, everybody's selling me on bigger pockets, what can I do with that? So your first hurdle here is the passive activity loss rules. And what it is saying, as it pertains to real estate, the first thing is, when you have traditional rental real estate, so just the traditional long-term, you have a tenant, they're there for a while, you're buy and hold, that is, as the IRS puts it, per se passive, which means it's by default passive. There isn't anything that, you know, unless you meet those real estate professional rules, that activity is passive, and there's nothing you can do to change that. So why does that matter? Well, if something is passive, the losses that you create within that activity can only offset income from other passive activities. So your wage income, that's not passive. Your brokerage income, that's not passive. You know, your self-employment business income, that's not passive. So all of those real estate rental losses that you create could end up, you know, siloed in its own bucket. That you have this giant loss, but you can't actually use it against all of this income that's generated in your tax bill. So what happens with those losses if you can't use them? Well, they get carried forward indefinitely. You know, if they're attached to a particular property, you know, when you sell that property, all those carry forward losses are released. But in the meantime, they just continue to carry forward to offset only your sources of passive income, which for a lot of us, that just tends to be within our rental real estate portfolio. Unless you qualify for a workaround. So that's really what we're all gunning for here. Is like, well, how can I offset my other sources of income? Well, there's really three primary ways to do that. So there's the small landlord exception, which requires no real work except for kind of coming in under certain income thresholds. Real estate professional status, which is the gold standard that a lot of people really think about. That's what gets a lot of attention online. And also it's gotten a lot more attention the last few years, which isn't necessarily a workaround, but I think it's becoming more popular because of the market we have is a quote-unquote short-term rental loophole. I mean, I don't like the term loophole. It's plainly written into the tax code. There's not really a loophole about it, but it's just a different way to go about your real estate investing that can allow you to take those losses against active sources of income. All right, so we're just gonna walk through each of those. So first we're gonna take a look at that small landlord exception. So it's really a series of steps here. So if you actively participate in your rental activities and your adjusted gross income is less than 100 grand, then you can take up to $25,000 of your rental losses against your active income. So those limits, the 100,000, the 25,000, those were implemented in 1986, and they have not changed a single dollar since then. Just for kicks before this presentation, I was, well, what would it have been if they actually adjusted on an annual basis for inflation? Well, that'd be more like 300 grand and $75,000 today. So, you know, these numbers have not really changed. I think a lot less people qualify for them than they did back in 1986, but it is still there. So in an example here, we have Joe Schmo here who makes 99 grand a year. So he's just under that $100,000 limitation. And let's say he acquires a rental property and he says, all right, well, I'm gonna go out and do a cost segregation study. So he's just saying, I'm just gonna take the basis of the property, I'm gonna accelerate as much of that deduction of the acquisition cost of the property as I can to year one. So let's say for him that creates a tax loss of $70,000. You know, that would probably take in the world we had just a year ago of 100% bonus depreciation, that would probably take a $350,000, $400,000 property. So not, especially in today's market, not that significant. So let's say, well, he's under that $100,000 threshold, so he can use up to $25,000 in losses. So he gets to use 25 of his 70 this year. That's probably going to save him about 5 grand in taxes, so not too bad. And then the remaining 45 is going to be carried forward. And so say next year that property's break even, well, he can use another 25 grand and he can kind of chisel away at that carry forward loss and keep on saving some tax on it. This one definitely isn't one that's been as common, just because people's incomes are going up and these thresholds have not changed in almost 40 years. So, but it's certainly one out there. I mean, the only tax planning that really surrounds it is look is like, okay, well, say you're going to be riding that income line of around that 100,000. Then you look at like, well, how could I utilize my tax advantage accounts, your 401k, your HSA, to get my income lower, so now I qualify for maximizing this deduction. So it's really a good way to kind of play with those accounts to, well, it almost incentivizes you in some ways if you're riding that income edge. All right, so the big one, real estate professional status. So this is let's see, the phone's coming up for pictures. At the end, we'll have a QR code that I can send everybody, anybody who wants, I'll provide information, submit your contact information, and then we can send you a package that has this information in it, in this flow chart. But the real estate professional status, that's the one people talk about all the time. And it's really a series of tests that the IRS is putting on you, saying, is this really your trade or business? Is this how you're spending all your time? And if you are, sure, you can use your rental losses against your other active sources of income. You can treat it as non-passive. So just walking through what these tests are, the first of them, and really the first two are kind of one of the, it's what you need to hit both of these check boxes in order to qualify. So first, are you spending at least 50% of your professional service time in your real property trades or businesses? So that could be construction, that could be on your rental properties, that could be brokerage, it could be really, I won't say quite anything connected with real estate, because unfortunately for CPAs, they've been tax court cases where they say, a CPA that works with real estate investors, yeah, that's not close enough. But if you're directly connected with real estate, whether it could be construction, you could be in the trades, whatever it might is, so at least half of your time there. And then saying, okay, well, one step further, not just half your time, but that also has to be at least 750 hours. So if we meet both of those thresholds, all right, congratulations. Under the IRS definition, you are a real estate professional. And I think the mistake a lot of people make is then they stop right there and say, okay, well, now I can use all of my rental losses, I can do cost segregation, I can do credit studies, whatever, and now I can offset my other sources of income. But that's not where it ends. That's just the first step. So say, okay, I qualify for this benefit. But all you've done there is to say that your rentals are no longer per se passive. They're no longer by default passive. But you still need to prove that you're actually materially involved in those rental activities. So it's very possible to be someone who meets this first test, but then you still can't take the losses because you're not actually involved in your rental real estate activities. So that's really the kind of the bottom corner here. It's saying, okay, well, congratulations, you made this first part. Now it's saying, it's like looking at your rental activities, are you materially participating in them? And we'll go into what those material participation standards are. But what that real estate professional status allows you to do first is to say, well, it provides you an option to lump all of your rental activities together and say, okay, well, I'm going to look at all of these to determine if I materially participate. And that matters because material participation is typically an hours test. So, if you have 10 rental properties and you're spending, 20 hours a year on each of them, well, if you're looking at each rental property as an individual activity at 20 hours each, you're not going to meet those tests. If you're looking at all of them as single combined activity, well, now there's a good chance you're going to be able to meet some of those tests. So that's why that election is important. All right, so moving on to what exactly is material participation. So it really is that there are 7 standards, and if you hit any of these, you're considered to materially participate. And I'd say for most real estate investors, the ones that matter are really the first and the third one. Those are the ones that most of you would check that box by. So did you participate more than 500 hours in the day, typically in the day-to-day operations? If you're full-time operating your portfolio, that's what you're doing 40 hours a week. Yeah, no question, you're spending more than that 500 hours. The other one you see there for at least 100 hours, and that's more than anybody else. So that more than anybody else, it could be a property manager, it could be contractors, subcontractors, whoever else is doing work on that property. It could be other partners that you have on the project. So that's why the 500 hours is a really nice one, because then it doesn't matter how much other time other people are putting in. You hit that threshold, and now you say, okay, well, now I can treat my properties as non-passive. I can take all those losses against my other sources of income. That 100 hours is a good second place, but if you have a property manager, you have a lot of other folks who are involved in the operation of your properties, and you're going to be much more fuzzy territory there. And some of the other ones here are really, have you materially participated in any of the 5 of the last 10 years? That's going to really matter the longer you hold rental properties, the longer that you're involved in this activity. Personal service activity, that doesn't apply to real estate. That would be, my profession as a CPA or an attorney, consultant, those types of activities where it is professional services. And then other facts and circumstances, which still, when you look into the details of that last one there, you say, it's like I run enough of my operations, even though I have a property manager, even though I don't hit any of those other hours thresholds. One to that last one, once you dig into the regs, the IRS still has the 100-hour threshold. So as to recap here, material participation, well, first check that box of being a real estate professional. You're spending more than 50% of your time in rental trades or businesses, and that's more than 750 hours. Next check box, I'm actually actively involved, meeting one of these tests in the rental portion of my business, specifically the rental. So we're going to run through just 2 very quick examples to help illustrate what this actually means. So first one, we have a George. So he works 15 hours a week as a W-2 employee. He's a part-time guy. So that comes to 780 hours a year. Then he also has 15 properties, and he's currently putting about 20 hours a week into managing those, 1,040 hours a year, 70 hours per property. So just walk through these tests, because I think that really helps illustrate what these tests mean. So does George spend more than 50% of his time on his real property trades or businesses? Well, yes, he's spending 1,040 hours on his rental portfolio. He's only spending 780 hours on his W-2 job, which who knows what that's in. So that's 57%. Check, he's over that 50%. Is he over the 750 hours? Yep, he's at 1,040 hours, so he's good there. We'll say, yes, he did group all of those rentals together, because it's like, okay, well, he's only 70 hours a year for each rental. So the only way he meets that material participation, at least 100 hours, is to lump them all together and say, I'm going to treat all my rentals as a single activity. I put 1,000 hours into that. And so did he materially participate in that rental activity? Well, he has this rental activity that he put 1,000 hours into. Lots more than the 500-hour test. So there we go. George materially participates. So now he can use those rental losses or rental activity to offset his W-2 income. I think one thing that's kind of illustrated here is you're looking at this, if you're working a full-time W-2 job, it's like, well, I'm never going to be able to qualify for this. It's like, well, as long as you remain full-time in your W-2 job, probably not. If you do full-time in your W-2, you're doing 2,080 hours. That means you need to do 2,081 hours in your real estate business. You're working 4,160 hours a year, 80 hours a week. Some people are doing it, not too many. What I always recommend to all clients is whenever you're riding this line, whenever you have something else going on, is to maintain a logbook that says, how many hours am I putting into these rental businesses? Because when the IRS audits you, if they do, that's going to be their question. Where's your logbook? What have you been doing? Where have you been spending your time? And if you're not able to show that, they could easily throw all this out and undo all those losses that you took. And then that starts to get a little bit painful. So keep those logbooks. All right, example 2. So this one is, and I think this is one where I've taken on a number of clients in the past that they've had prior CPAs that have left this slide as being checking the box as real estate professional status, but it didn't actually make it. So in this case, we have and George too here. He works 40 hours a week, 2,080 hours a year as a real estate agent. So he works effectively for himself. All real estate agents tend to be 1099. They're contractors. So right there, we're looking at that question of, does he spend over 750 hours in real property trades or businesses? Well, yeah, he's a real estate agent. He's spending 2,080 years. He blows that requirement out of the water. And then we're looking at, okay, well, what about his rental real estate portion of his business? Well, we're saying, he's spending what comes to 416 hours a year in his rental portfolio. And he's completely outsourced all the day-to-day management, all the tenant decisions, all of that. He's outsourced to a third-party property manager because he's too busy with his day job. So the property manager is spending substantially more time than George is here. So we walk through the first few tests and we say, okay, well, yep, he spent more than 50% of his time. In fact, he spent 100% of his time on real property trades or businesses, and that was well over 750 hours. So at that point, yep, George is a qualified real estate professional. So and someone will stop right there and say, all right, I'm good to go. But the problem is, then you need to look at step two. It's like, does he materially participate in his rental operations? Well, in this case, he doesn't hit that 500-hour test. He does do more than 100 hours, but somebody else is really doing all the day-to-day work. So under IRS definitions, he does not. So even though he is that real estate professional, he cannot utilize those rental real estate losses against his real estate agent income. So what could George have done differently here? He could have put in another 90 hours. It wouldn't have taken too much for him to get over that 500-hour threshold to then be able to take those deductions against his agent income. All right, short-term rental loophole. So this has been a pretty popular one over the last few years, really with Airbnb, VRBO. As those have exploded, so has the information and misinformation about this tactic. So what does this tactic actually mean? It's saying, okay, well, we all tend to think of it, it's rental real estate, right? It's all kind of the same thing. There's different approaches, but it's rental real estate. Well, the IRS has a specific definition of what is rental real estate. And their definition says, okay, well, rental real estate is the rental of any real estate, but it excludes anything where the average rental period is 7 days or less. So there you go, a lot of Airbnb, VRBOs. And it also excludes anything that's where the average rental period is 30 days or less, and you provide a substantial number of services. Think like hotel, motel type operation. But if you fall into one of those two buckets, you're no longer considered a rental real estate activity under the IRS code. It's just an ordinary operating business. So this is great. So it's no longer per se passive. It's no longer by default passive. So you no longer have to hit those real estate professional rules in order to take the losses. And we'll have an example here of one of my clients and the results they got out of this past year. But what it means is like, okay, it's no longer a rental operation, it's ordinary income. If I do a caustic study or something else to accelerate losses, I can offset my W-2 and other income. But what matters here is, instead of dealing with those real estate professional rules, so really you get to skip that first part where you're looking at, do I have the 750 hours? Am I putting at least 50% into my real property trades or business? You don't have to worry about that piece of it. You still have to worry about the second piece, which is, did I materially participate in those rental operations? So that was that 500-hour rule, that was that 100-hour rule, and more than anybody else. But if this is planned for correctly, this is a very powerful tool to offset income from a W-2 job. All right, so our first example, and this is an example from an actual client that I have. Names and occupations have been changed. But so Jack and Emma acquired an Airbnb property. It was about $350,000, and they bought that in 2023. One of them works as a doctor making 350 grand. The other one works as an HR manager making 130. So they're doing pretty well for themselves. You know, they're certainly well over that small landlord exception. And they came to us and like, well, I'd like to be able to use some of the losses. And our response is, well, you can't do it with traditional real estate, but you know, if you're interested in investing in Airbnbs, VRBOs, like maybe there's an option for you. And we went down this task, and we talked through it. We let them know everything that they would have to do, and they decided to pursue it. So we did the breakouts. All right, how much is building? How much is land? They went through. They did a cost segregation study. You know, that first year, everybody does a bunch of new furnishings in that Airbnb. But you know, between all of it, what it came to is that property generated a first year paper loss of $145,000. So that's what showed up on their tax return. In reality, they had their down payment and they were out 25 grand of furniture. You know, there's still some value there. So it's either true out of economic loss. It wasn't really there. This 145 grand was essentially just a paper tax loss. So walking through those standards, like, all right, was the average rental period less than 7 days? Yeah, in their case, it was only 4 days. Did they materially participate? Yeah, they did. This initial year, they decided, all right, we're going to 100% self-manage. We're not going to use a property management company. We're not going to use another cleaner. We're going to make sure that, and their reason for doing so was 100% to hit these hours to meet the IRS rules. So they kept an hours log. They kept track of everything. They booked 250 hours. All right, well, so they did more than 100 hours. That was more than anybody else. So what did this turn into? Well, they're not real estate professionals, but they were able to use that $145,000 loss, and it saved them $50,000 in taxes, which in their case ended up being more than the down payment that they put on the property. Wow. So, and you know, bonus depreciation is going down, so it's not quite as good as it used to be if you did that this year or next year. But it's still an example of a way to approach your investment strategy a little bit differently and get a substantially different tax result in a way that could, you know, really, you know, if they bought this as a traditional long-term rental and created a, you know, so it doesn't meet this loophole, as it were, then they would not have been able to use those losses against their W-2 income. So it's just a matter of changing how they're going to operate the property. And is it more work? Absolutely. Yeah, an Airbnb is certainly a lot more work than just having a single family with one good tenant. And I think that's one thing that I always warn people about when you're looking at this is saying, okay, well, it is a different strategy that you're taking. It's a different business. And first and foremost, the tax benefits, yes, they look fantastic, but make sure it makes business sense first. Because if you end up with a garbage property that saves you a bunch of money on taxes, well, then you're going to sell a garbage property and recognize a bunch of depreciation recapture, and you're going to end up in a no better spot than you were. So it's a way that I certainly recommend you if you're looking at doing Airbnb, VRBO, excellent strategy to pursue. Definitely one to talk about with your tax advisor. But don't do it purely for the tax benefits. Make sure it's a good business decision as well. So here's an example that I created just saying, it's like, okay, well, what if they went about this, but they didn't do it right? They didn't plan for it. So all of the facts are exactly the same except for one. They hire a property manager. And that property manager takes care of all the cleaning, they take care of all the bookings, they take care of all the headaches and the person that can't find out where you stored the toilet paper, you know, all of those stupid questions the property manager is dealing with, and they put a whole bunch of time into managing that property that year. We'll say the taxpayer put 150 hours in, but it was much less than the property manager did. So all of those same circumstances, but because they hired a property manager and now they did it less than somebody else, with those material participation thresholds, they don't get to take that loss. That loss it's considered passive, it's disallowed, it carries forward. So it really ends up being a bit of a loss for them. But you'd say just with better tax planning, if they had a conversation with their advisor and it came and was like, well, yeah, if you're gonna do this, just maybe self-manage, at least for the first year, see how things go. If you decide you hate it, then hire out a property manager. And at least that first year, you get all those tax benefits, and there's no recapture on it year 2 or 3. So it's definitely something worth having that conversation over. All right, so now we're moving on from some of the passive activity loss issues. And this is an issue that I wanted to highlight just because it's something that I see so commonly when I see new partnerships come into our business, where they've had maybe a smaller firm or someone who didn't have experience in these issues deal with it in the past. And so, say that, I'm sure there's quite a few people in here who have investors invested in their project where all they did is provide money for equity. They're not doing management, they're not participating in any meaningful way. They just said, I'll give you $100 grand for 25% of this deal, and you're gonna take care of everything. A syndication type structure, maybe it's a family and friends, but whatever it is someone else, there's people who put money in and are doing no work on the project. So there's a bit of a tax trap here that people need to be aware of, because what people will often think is like, oh, well, I can still do that cost segregation study. I can accelerate all that depreciation to year 1. Yes, you absolutely can. But then there's this little bit of a carve out here where the IRS is like, well, let's take a look at this. We have something that we're going to call tax shelter, and some special rules we're going to subject you to if you're considered a tax shelter. And what are we going to consider a tax shelter? Well, if you're allocating more than 35% of your losses in a given year to limited partners, those who are doing absolutely nothing towards a deal, they just providing capital, nothing else, then we're going to call you a tax shelter. So say you have someone come in and we're 50-50 partners, they're putting in a bunch of capital, and I'm going to do all the work, and then they get all those losses year 1. This is a great idea, but now this is a tax shelter under IRS rules. And really, this is a year-by-year measurement. There's some look-back rules, there's some other issues, but we're not going to get into that. But the important issue is that now you're a tax shelter and you're subject to something else. Well, what else am I subject to? What's my problem here? Well, there's these other set of rules that you're subject to if you're a tax shelter, and those are business interest expense limitations. So the IRS says, well, if you're a tax shelter, we think you should only be able to deduct so much of your interest expense. And that number is 30% of your earnings before interest and taxes. So you don't get to add back your depreciation or your amortization, anything else. It's just 30% of that earnings before interest and taxes. So you're like, well, still, what's my problem here? Well, say you do a cost segregation study year 1, you create this giant loss, and your EBIT is negative. Well, now all of your interest expense is disallowed. This is something that it's overlooked very commonly. And there's some solutions to it, but those solutions have to be actionable, they have to be discussed. So there's a real property trade or business election, which is a specific election which requires you to depreciate things in a different manner. For multifamily properties, not really a big deal. Instead of depreciating your building over 27.5 years, now you have to do it over 30 years. That's something, but I'll do that and get my interest expense. That's not a problem. But for commercial buildings, it's really significant, because there are some portions of commercial buildings that otherwise you'd be able to get bonus depreciation on that now you can't if you have to make this election. So especially with commercial properties, it's something that you really want to make sure you talk over with your advisor. Hopefully they're asking you these questions to highlight some of these problems. All right, so now we're going to jump over to something else that I also see all the time. So we're here at in New Hampshire. I'm assuming most of us who are investing are in New Hampshire, and we all get the advice, buy each property in an LLC. That sounds like great legal advice, segregate some of my liability. Hopefully you're actually respecting each of those LLCs, but I'm not an attorney, so we won't get into that.